So thanks for us for tuning in again. This week our guest is Joe Beinfrander, but you may remember he was talking about AVI Global a few weeks ago, but this week he's going to be talking about AVI Japan Opportunity, which is a fund that we quite like. So without further ado, some news. Two bits of things struck me this week. So first off, JPMorgan Elect is going to merge with JPMorgan Global Growth and Income. And the second one is that JPMorgan Russian has actually published its proposals to change its remit to become a much broader fund. So we'll talk about those two things. JPMorgan Elect first, a bit of history. It's actually been going for quite a while. It's launched in the tail end of 99 as fame managed growth. And it was a rollover vehicle for something that had already been going for 5 years at that point and actually had quite a good track record. And it basically was designed to invest in investment trusts managed by Flemings. That was the idea of it. In classic sort of late 1990s, 80s style, it was a global fund, but it was actually had quite a big bias towards the UK. And that was something that was quite a feature of the global sector for a long time and took a while to kind of get rid of. So it was 65 UK, 35% global. And it was quite innovative, actually. And one of the things that I really liked about it at the beginning was that it did things like stock swapping loan notes issued in exchange for takeovers into the fund as a way of people managed to roll over their capital gains without crystallizing them. So the first one it did was with Walmart's takeover of Asda, and that grew it by £32 million. But then the big one was when Chase Bank took over Flemings, and it took in £91 million. Could have been even bigger than that. I think it was ever going for 500 million, but still 91 was not a bad result. Of course, JP Morgan bought Chase quite soon afterwards, which is why these things are all badged JP Morgan. There was a separate managed income fund launched in 2000, and the two were kind of running parallel, but the managed income fund was never very big. So in 2003, they decided to merge the two and create what's now JPMorgan Elect. And it's run as three separate pools of assets, but under the same fund. So you can effectively buy shares in the managed growth or shares of managed income or shares of managed cash. Each have a distinct pool, but you can swap between them without actually triggering a capital gains event, which I quite like as a structure. And I sort of thought it was something that might actually take off. But I suppose people haven't wanted to switch between growth and income that often, and so maybe that's the reason that it hasn't actually done it maybe as well as it could have. It started for a reasonable size. It has actually grown since then as well. Here's the managed growth one, and that's actually got a very good track record, as you can see there, with that whole thing growing. It has moved out to trade at a wider discount since the whole events of March 2020, and that hasn't really narrowed again since, which is a shame really, but it's not ever got very wide because at any point in time, well, that's a certain point in time, you can switch from managed growth or managed income into managed cash and then cash those shares in asset value. So that's what keeps the discount relatively tight, but it hasn't ever been sort of trading at premium, been able to expand that way. Managed income, less of a success story, it has to be said. You can see there that basically the NAV is flat for 10 years. Really not all that. Managed cash, well, the returns on cash have been negligible for a long time now, and so have the returns on that fund as well. Managed growth, then, here it sits in its growth sector. And you can see there with market cap of about 250 million and a reasonably tight discount, it actually doesn't look too bad in that context. In terms of its returns though, over 5 years, they're not amazing, as you can see there. Over 10 years, that is better, but it's only just ahead of the benchmark. And it's still got a kind of 50-50 weight. UK global, which, as I've said, is a complete anachronism now. And I think that's one of the reasons why JPM decided, well, let's just get rid of this. within the equity income sector, UK equity income sector, which we said before, I think there's far too many funds. The JPMorgan Elect managed income has got a reasonably attractive dividend yield, and again, obviously, it trades this type discount because of the structure. But it's not very big, so it's only 67 million market cap, and it's one of the ones that you think, well, actually, you're going to have some consolidation, then probably ought to go. And then, as I've been saying for a while now, the limited pool of investments that you can invest in to get income from in the UK, although it's not too bad, it just sort of makes sense to me to go to a more global remit, and that's been the trend over time. So what's going on here just seems to be following the normal kind of trend. In terms of its returns, they have, as I said, they haven't been very good. So if you look at the share price over 5 years there, we barely made it positive. And it's behind its benchmark over 5 years as well, and only barely ahead over 10. So the proposal is Section 110 reconstruction, which is a way of avoiding triggering capital gains tax, into JPMorgan Global Growth and Income on a kind of NAV for NAV basis. So that still works, even though the Global Growth and Income Fund is trading at a discount at the moment. So this is a similar situation that we had a few weeks ago with Harmony Energy wanting to do a C share, and all the shares trading at a discount. It doesn't matter, it's not diluted because it's all been done on an NAV basis. You have a straightforward swap if you're in the managed cash or managed income pools into the Global Growth and Income shares. But if you're in the growth shares, because they've got some liquid investments in there and they didn't want that to contaminate the Global Growth and Income portfolio, that you're going to go into C shares. Once that portfolio has been aligned with the rest of the fund, then those two will merge. So actually, I think it's quite a good structure. It's just showing that the whole thing works. Now, what I realised was, because I've never sort of thought about where the word C share came from. I think this came from way back at the beginning here, when they were doing the Chase Fleming thing, and they issued conversion shares. And I think that's where the term C shares came from. If somebody wants to correct me, I'd love to know, but there's something just occurred to me this morning. Anyway, you can get out, and this is another thing that I like about this deal, you can get out for cash at NAV by swapping into the managed cash portfolio now. You have to do it before 15th of November and then tick the cash box. And that gives people who don't want to go into this thing an exit. But actually, it's not a bad option. As you can see here, these are the returns for the global equity income sector and JPMorgan Global Growth and Income within it. And obviously, its returns are best in the sector over 10 years, and definitely in terms of price as well. Not quite so good over 1 year because of it's more of a sort of lower yielding growthy type portfolio and manufacturing income out of capital. So more traditional equity income funds like More International have been doing much better. But nevertheless, over the long period, it's done okay. But relative to the two funds that are rolling into it, it's outperformed pretty consistently and actually quite impressively. If you look at the returns of this fund relative to JPMorgan Elect Income, you can see that it's way ahead. And part of that is this slight bias to growth, and part of it is because it's been able to invest globally rather than being stuck in the UK. So that's why I think this completely makes sense. So it's going to take global growth and income to about 1.7 billion in assets. And the question's been asked to me, is it growing too fast? I don't think so, because what's investing is quite liquid. And I think it could be a multiple of this size without constraining the manager. Another good thing about the structure is that the manager is covering most of the costs of it. And the ongoing charges ratio for the whole fund should fall. So that's the attraction for if you're a global income shareholder now. And can come down to something more like what it is for the managed growth portfolio at the moment. You're going to actually get a cost saving from the managed income one. The yield comes down if you're an income investor. That maybe is the only kind of drawback. So you are going to get a lower dividend. As I said, the yield on this is based on a percentage of NAV. So it's at least 4% of NAV is the way that they do it. It's struck at the end of June. So if the NAV goes down now from here, and at the moment we're sort of probably about worse where we were. If the NAV goes down now, so then in theory, then the dividend would come down too. But they had that situation in June 22, and actually they edged the dividend up. So actually paying out 4.2% of your NAV. That eats into your capital returns. And we'd have to see if we have another year when Murray International type investing does better than global growth and income type investing, then people might query whether this makes sense or not. But I think for the moment, it's actually still a winner and people still like it. So we'll see. JPMorgan Russian, we know the history of that. We've talked about this a lot of times on the show. It's been trading its enormous premium, really quite daft. That's come down over time, but it's still quite high. It wants to expand its remit to compete with the Bearing, Emerging and the Opportunities Fund, BMO, that we've talked to on the show in the past. The name of the fund is just ridiculous. I mean, JPMorgan Emerging Europe, Middle East and Africa Securities. Somebody's going to come up with some kind of acronym to give an abbreviation. But it invests in that kind of emerging Europe, Middle East and Africa, MENA type investments, which as we said, we've talked about Gulf as well. That's quite exciting at the moment. Emerging Europe will presumably come right if the war stops. I mean, there are, there's swings and roundabouts to all of this. Africa's exciting, but riskier. So I think it's not a bad option, and there's not a bad thing to have a competitor to BMO. Shareholders need to approve it. There's a meeting on the 23rd of November. The problem, obviously, is that what we're talking about here is a fund of effectively £17 million, because you've got about £2 million worth of Russian investments, which you can't do anything with. You can't sell them. There's nothing you can do with them. So all you've got is the cash, and the manager wants to reintroduce the fees on that cash if this goes ahead. So there'll be sort of an ongoing expense ratio, maybe sort of 2%ish. I'm not sure what that's going to work out. It's way too small, way too small. And I just think that existing shareholders, if they think about it, are going to object to the whole idea, because presumably JPMorgan are thinking, well, it's trading on a 68% premium on this hope value of the Russian assets worth something. We can just issue stock and expand it. And you could keep issuing stock until the premium comes down to zero, and see how much money you've got to play with then. But if you're the shareholder that's hanging on and hope the Russian assets are worth something, and are you going to support this share issuance that's going to dilute your exposure? I don't think so. So I just don't think we're there yet. I mean, I think the proposals need some rethinking, and I just think it's all too complicated for a tiny fund, and it should just really just pay out the cash that it's got, keep a little bit back to keep it ticking over until something happens with Russia, and then delist probably, because why bother with the listing fees? So that would be my solution, but at the moment the board seems determined to plough on. So to answer a couple of questions that popped up, Murray International Type Investing is basically buying high yielding stocks taking your income, dividend income from that, and covering your dividend from the revenue that you generate, as opposed to global growth and income is buying lower yielding stocks, not covering its dividend with income, converting capital into income. So Murray International is much closer to a value type investment, whereas JPMorgan Global Growth is much closer to a growth investment, if that makes sense. Why are JPMorgan entertaining prospect of £70 million fund? I don't know. Assuming the board are driving this, but JPMorgan who just said no, but there we go. That's enough from me. Let's now talk to Joe.